Hey all, welcome to the third and final day of the Advice Residency Post-Match Financial Education Seminar. We've talked about all sorts of things this week: student loans, federal and private, credit card debt, employer benefits, cash flow management, budgeting, investing, um, figuring out whether or not you should buy a home or rent. We've talked about all sorts of things. And today we've got a few more excellent topics that I think you'll find to be very useful. Um, our first speaker is Dr. David Roney. He's going to be talking about managing credit scores and good borrowing practices. After that, Michael Relvis, a specialist in disability insurance for physicians, will be discussing some more specific things about own occupation disability insurance and riders and things like that. Um, and then after that, for those of you that you're not able to moonlight this year as an intern, but you might be able to in the future, and taxes are going to become an issue. And Anna Njai Kante, she's going to be discussing that with you. She's a financial planner. And then Dr. Tarang Patel, he's going to be discussing how to protect yourself from the financial industry as well as the physician finance space. And then lastly, I'm going to discuss the writing of a financial plan, how it can be all brought together into something organized and actionable. So appreciate you all being here. I look forward to your questions. You can ask questions in the Q&A. And then after each speaker is done with their part, they'll go into a breakout room, and you're welcome to go there if you have additional questions for them. So I guess that's all I've got. So first, friend and an expert in both medicine and finance, Dr. David Roney is going to be discussing managing credit scores and good borrowing practices. So David, we look forward to your part. Go ahead.
Hey, thanks, Tyler. I appreciate it. The invite. I see a lot of people that I know who've been doing this, and I heard um, Nee Darko kind of brought a lot of energy, right? So, like, I kind of feel like I can't just not bring energy. I feel bad this is on Zoom because I like to be in front of people. I like to talk to people. I like to see their faces, their reactions. The biggest thing about before we even talk about anything, congratulations. That's the first thing that needs to be said, right? Because you've gone through this long journey, and then now you finally gotten over the hill, got over the hump with medical school, and then guess what? You're back at the bottom of the totem pole. Or you graduated residency, and then you're a brand new attending, and you're bottom of the totem pole again. It's going to happen to you over and over and over again in life. Now, there's one thing when you're starting over in medicine or you're getting to the next step, you can sort of recreate your reputation. With credit scores, you can't really do that. That's going to follow you from the moment you turn 18 till you die, right? And some people don't pay attention to their credit score. And I can tell you, if they don't pay attention to their credit score, they're in a couple of situations. One, they're either not financially smart to the point that they realize what is going on around them, or their income's so high that they never had to pay attention to their credit score. Credit scores are important because it actually affects everything you do. Whether you're getting a job, guess what? They pull your credit score. If you are applying for a mortgage, credit score. Applying for a loan, credit score. Applying for a new student loan, credit score. It is going to follow you literally everywhere. If you're getting a medical license, guess what? They look at your credit score. For some reason, those three numbers are tied to what people believe your worthiness is. Now, if I look myself in the mirror, I go, man, I feel like I'm pretty worthy, right? I eat a lot of waffles. So right off the bat, that makes me worthy of things. And if to all the pancake lovers in the room, I'm sorry, your credit score probably needs to drop because you're eating pancakes. But that's another story, right? Your credit score, those three numbers, right? And there's a bunch of different bureaus. I won't go into each one, but just know there's Equifax, which you probably heard of them previously because they had a giant hack and people's information got breached. Or there's TransUnion, and so there's three major bureaus, and what happens is a employer, a bank, a car dealership, they may inquire or request a credit score from one of the bureaus. Each bureau is going to have their own way of determining what your credit score is and what factors they're looking at. Some of the consistencies across the credit score are your payment history. So if you aren't paying things on time, and guess what? In residency at the beginning, in intern year, I was so swamped with stuff, I forgot to pay one credit card payment. I was 2 days late, right? You get 30 days, and I came in at 32 days and they reported me. And that was 10 years ago. And that bank still has not taken off that thing off my credit score. Now, my credit score is great, but it is still annoying every single time I see that one payment. In the history of me having a credit card with this bank, actually, since I'm gonna date myself, uh, for 23 years, I've had that credit card, and I have one missed payment the entire time, and it's on my credit history. So your payment history is huge. Another thing that's huge is your debt to income ratio. And you're going to hear that a lot. You're going to always hear people talking about that. Whether you're getting a mortgage or you're applying for a new loan, everyone wants to know what your debt to income ratio. The other thing that's important is your debt to credit ratio. The tough thing about a credit score is if you don't have one, it's like you don't exist to the financial world. No one really knows who you are and how trustworthy you are. And it's sort of a paradox, right? Because banks want to lend to credit worthy individuals, but if you have zero score or you have no credit history, you're deemed not worthy, right? You can be very good with money, use cash 100% of the time, but it's actually bad for you to do that. And so I tell people, whether you're making $50 a month or $50,000 a month, you actually have to know what your credit score is because it affects everything. If you want to get a great rate, and we're talking rates that where the bank really isn't making a lot of money, right? So banks typically make money on the spread between interest rates. So that loan is part of their doing business, and they have to make a spread on the how much they can borrow versus how much they can lend out. So that spread. Banks compress that spread when you have a great credit score. So whenever you see those, hey, 0.9% APR, come get a car for 72 months, those are only for individuals with great credit scores. And I'm talking about above 720. Now, when I graduated from the Naval Academy, again, going to date myself, in 2007, my credit score is 520. Let's just say that's really, really bad. And I had no clue. And I was a college basketball player. I was poor, but all my teammates had money. And when we would travel, there was all these booths throughout the airport, specifically Baltimore Washington International and BWI. And it would be a Southwest credit card, Bank of America credit card, and I would always get hooked in. I didn't really understand how credit works. So I would sign up, and sooner or later, I had 10 credit cards with low balances, $100 here, 150 here, and I just screwed my credit up, and I had no clue. Once I caught wind of what I did, right? Because someone basically had to knock me over the head and say, hey, you're actually screwing things up. They made me cut up my cards, but then I started getting financially responsible and I started understanding how credit works. I did something that is equally as bad as opening up a bunch of cards. I canceled all of them. That's actually worse. And the reason being, banks don't like to know that you're a part-time customer. Their whole thing is they want customers who are going to last a long period of time. The longer you have a relationship with the bank, the more often they are going to give you better terms on the things that you're dealing with, on transactions you're dealing with. So if you are like me, my 17, 18-year-old self, getting all those credit cards, and you wind up in a situation like that, let's say you are in a situation like that, because residency and med school, you're going on a lot of interviews if you're doing fellowship or you're applying to residency, and sometimes you rack up credit card debt. Don't be ashamed of it. 100%. The financial world will try and make you feel ashamed of it. They aren't in your shoes. So don't listen to any of them. I'm just going to flat out tell you, don't listen to the Dave Ramsey's of the world. I'm going to get on Ramit here because he goes off on people too about it. So I'm going to say, don't listen, give yourself some grace, right? They aren't in your shoes. They aren't physicians. They aren't in the medical world. They aren't trying to get the residency of their dreams. Unfortunately, that's the price of doing business if you don't have money. I grew up poor, right? Who was I supposed to get money from? No one was going to help me pay for interviews and flights and cars and all this stuff. So give yourself some grace. That credit score, your credit history, the length of your credit, how much you have in credit, all those things are important. Once you start to establish, hey, I have a good payment history, that's one step. The next step is once you establish that you have a good credit or you have a card for a lengthy amount of time, you need to actually tell the bank, hey, I need to increase my limit, right? Because that actually goes into getting a better credit score. It's a way to hack the system. So debt to credit or available credit is important. How much of a revolving line? Are you paying the bill off every month? Are you paying a statement off, or are you just paying the minimum? You got to understand, most things in finance compound, and debt compounds. The worst debt you can actually have is credit card debt, because it is easy to fall into the trap of paying the minimum. Sometimes it may look like $50. Sometimes it may not look like $50. But a bank wants you to pay the minimum because that's how they get the most amount of interest payments. So if you're just paying the minimum and you're doing it every month, you're going to get a great credit history, right? And payment history. That's going to look amazing. What's not going to look amazing is the fact that you have this high balance to amount of credit that you have, available credit. So you want to try and keep that number less than 30% is the ideal. And I say 30% because that's where the bank is actually like, okay, is this a long-term customer of mine or is this a short-term customer of mine? And it's important to remember that ratio of 30%. Just keep that in the back of your head. And that goes from whether it's your overall debt to your income or it's your credit, the amount of revolving credit that you have or credit at any one point and the amount of balance that you hold. If the most ideal scenario is that you use your credit card responsibly and you pay off the statement every month. And the reason why you pay off the statement is any residual balance after that statement actually accumulates interest. So credit is unique where every month the interest accumulates interest. It just becomes the new amount of the credit that's remaining. So you have to understand how that affects you. There are other little things, and this is the biggest hack. If you take away anything from me, if your parents have great credit and they have a long-standing credit card, let's say like an Amex Platinum or Amex anything, a long-standing credit history, and they have great credit, you can hijack their credit score. You can hijack their credit history by asking them to allow you to be an authorized user of their card. You don't even have to use the card. You can tell them, hey, cut up the card. I don't need it. I just need your credit history. And that's the easiest way to get to an 800 credit score. So when I have a soon-to-be 14-year-old, if anyone has kids, they understand what I'm going through, what it's like for teenagers, because they're teenagers. But when she turns 18, the first thing I will do is put her as a user on my Amex. Now, will I give her my Amex? That answers absolutely HE double hockey sticks. No, there's not happening. No way will I give a teenager an Amex Platinum. It's not happening. But she will get my credit score. And that's important. The credit score, yes, at some point you will make enough income to the degree that you don't even have to ever worry about, right? Because at some point, what I like to tell people is your income will get high enough that you will make more than your budget can even account for. Same thing with the credit. So if you have enough income, you can overcome a few things. But early on, until you get to that point, that credit score matters. It matters for your student loans. It matters for personal loans. It matters for your mortgage. The worst thing is being told that you really want to buy a house and you can't. Even with the physician loan, they have credit scores that sort of you have to qualify for. You think you're going to put zero down? Guess what? That's only for people with great credit scores. So the easiest way to monitor your credit is to sign up for a service, and I'm not paid by them or anything like that, for like Credit Karma. Equifax, TransUnion, they will all give you a copy of your report, well, at least one per year. I personally pay for Equifax I pay for this subscription so I can actually see what my credit is like. And every year you need to review it because people do get their information stolen, and you don't want to find out that there's 10 lines of credit on there that you never even knew existed, because that happens. And you can dispute things on your credit. It doesn't actually have to stay there. You can get it removed. Now, probably the question is why didn't I get the Navy Federal thing removed? Well, it's kind of like reverse psychology. If I know that that thing is there and that's what happened to me before, it's a reminder for me never to miss a payment ever again. And that's credit in a nutshell. 20 minutes, right?
Yes, sir. Man, that was great. It's like one of the most uninteresting but super important topics. And I remember you talking about it for a few years back, and I'm really appreciative that you were willing to come here and explain it, because it was really easy to understand. So thank you. Thanks a lot, David. Now,
Thanks, Tyler.
if you would like to ask David any additional questions, there's a breakout room with Dr. Roney's name, and you can move yourself there and continue talking with the specific questions that you have, and then you could bring yourself back when you wish to. So thanks again, David. All right, let's move on to our next part. Our speaker is Michael Relvis. He is an expert disability insurance agent. He specifically works with physicians, and it's not. I emphasize that because there's a lot of people that sell disability insurance, but there's not a lot of people that really understand the way in which you need to communicate with insurance companies and understand contracts and riders and the relationship to your residency and fellowship programs, group policies. So there's a lot of nuance to it. And I'm glad to know Michael for several years. And he's going to talk now about some specific things related to own occupation disability insurance definitions. I know it sounds like it might be boring, but this is important. So please pay attention now. Michael, we look forward to your part.
Thanks, Tyler. So you said there was not too much more boring than credit, but this is about to be it. It's insurance. So here we go. I get the pleasure to talk about one of the most boring things ever. Welcome. Thanks for listening in. Hopefully I can give you 20 minutes of some solid information. Disability insurance is pretty complex. It's actually not that difficult, in my opinion. I just think that there are a lot of details. A normal presentation on this could easily take an hour. We're going to try to cram in 20 minutes and give you some really good information. So for starters, what is disability insurance? So disability insurance is a type of insurance that is intended to replace a portion of your income if you are too sick or too injured to work. That's really what it's intended to do. You can have it in multiple types. There are group policies that your GME office or hospital employer would provide you. There are also individual policies. So without going into too much detail on this, the general rule of thumb is that while group disability policies are helpful, they're great, they're usually free because they're paid for by the employer. The provisions, the definitions that are involved are not quite as favorable as what you can get on an individual disability insurance policy. And so we're going to talk about some of those differences and some of the provisions, some of the better versions out there. Why is disability insurance important? So you may not have heard it yet. By the time that you finish your residency, you will probably have heard it 1,000 times from multiple insurance agents and your attendings, from everybody, that disability insurance is really important. You should buy it. You should buy it during residency. They'll give you a lot of different reasons. They'll talk about how there are discounts, there are unique programs, there are all these great things you can get by buying it during residency. And a lot of that is true. There are some advantages in getting it during residency, but I feel like more often than not, the main focus of why you would want to buy it during training is entirely missed. And the reason you want to consider it is because you need the income protection. At this point, we're just about 4 years into your, medical journey here. Depending on what your specialty is going to be, you might have 3 more years, you might have 8 more years. And as the years tack on, your investment into your craft and into your earnings capability, right? This is about finance, so we're going to talk a little bit about income and money. You're investing a lot of time into that career path and into that earnings potential. So every year that we tack on is more investment. And if you, God forbid, become disabled, we're in trouble. That's a lot of years of investment that you're not really getting the payout you wanted and that you expected, right? Money might not have been the reason that you got into this, but certainly it is a big part of what makes it worth it. And so that's why it's really important. It's important to have because we need the income protection. Yes, there are advantages. Yes, there are discounts. Yes, it is less expensive when you're younger. Ideally, you get it when you're healthy. But the real important thing to consider here is that we need income protection. Unless we're independently wealthy, that's why we actually need disability insurance. So I'm going to talk about, there are plenty of riders. Like I said, we could spend a lot of time on this. I'm going to really focus on 2 very important parts of disability insurance policies, and that is the definition of total disability and the definition of partial disability. So these are the 2 circumstances or the 2 definitions that explain the circumstances under which you are most likely to ever collect a benefit from these policies. And there is a lot of industry jargon, marketing wording. There are a lot of different names that are thrown around to identify some of these things. And while some of them are somewhat alluding to the truth, they can also be a little confusing and really make this seem more complicated than it needs to be. So I'm going to try to break this down into conceptual ideas, right? So the definition of total disability, well, that's pretty clear. It defines how you will be considered totally disabled. In most of the contracts that the big 5 companies, the top providers out there offer, the definition of disability will say something like, you are considered totally disabled when an injury or a sickness prevents you from performing the material and substantial duties of your occupation. That's actually what the contract is going to say. So if you see marketing, if you hear a colleague talk about it, they might say, oh, don't forget, make sure it's an own specialty policy. That doesn't really exist. That's not anywhere on the contract. It doesn't say own specialty. It might say own occupation, but it's really important to understand what the concepts are. So material and substantial duties is what the insurance companies are looking at. What are you actually doing? What are you doing on a normal daily basis? What are you being compensated for? What is really the objective of your position? That's what they want to know. And they also want to see how much income is being derived from each of those duties, right? What is considered material and substantial? And these policies will cover you in your medical specialty, but not because your co-resident said, oh, get an own specialty policy, because the contract actually says that it is specific to the material and substantial duties of your occupation. So naturally, an internal medicine physician is going to have unique material and substantial duties that are different from that of an orthopedic surgeon or an anesthesiologist or an ophthalmologist and so on and so forth. And that is why these are actually specific to a person's medical specialty. It's because it's based on the material and substantial duties of that occupation. There is nowhere in the policy that it is specifically going to say you're considered totally disabled if you can't work as an emergency medicine physician. It's just not going to say that. It's going to say occupation. It is also then going to define occupation. And occupation is the material and substantial duties that you were performing for remuneration, right? So for income, at the time that the disability occurs. And so I'm going to try to wrap this all back together for you here. Total disability is when you cannot perform, because of an injury or sickness, the material and substantial duties of the occupation you were performing when the disability began. So let me give you some examples here. If you start training as internal medicine, categorical, right? So we got 3 years ahead of us. And you don't know it yet, but you end up going into cardiology, and then you end up doing an extra couple of years into interventional cardiology. And you bought this policy as a PGY1. So when you first bought it, you disclosed on the application that you're internal medicine. Great. It's covering you as internal medicine. Fast forward 7 years later, you're now an interventional cardiologist. You don't need to replace the first policy that you purchased. It is naturally going to cover you as an interventional cardiologist because of the fact that it's always based on what you're doing at the time of claim. It's based on that occupation. So it can become more specific. It can also become more broad, right? So let's say that you're working as a physician, whatever the specialty is. You develop a side gig. That side gig becomes very profitable and exciting. And next thing you know, you're doing more of that side gig than you are actually practicing medicine. Although you bought the policy as a physician or a resident, whether or not you can do that may not actually matter anymore. It might be based on whether you can perform that side gig because it's taken up so much of your time and actually creating so much income. So the takeaways here are there's a lot of industry jargon. You'll hear a lot of different names for this. Conceptually understand that these are specific to your specialty because they're based on the material and substantial duties of what you're doing. And each medical specialty has unique material and substantial duties. That is why it's actually specific to your specialty. So with disability, unlike life insurance where it's black and white, disability insurance and disability in general has a lot of gray areas. So we might not be totally disabled, we might be partially disabled. And partial disability is also really important to consider because again, it's one of the two most likely ways that you're ever going to collect from these types of policies. Partial disability is entirely based on income loss or time or duties loss that is caused because of the injury or sickness. So by definition, you're not totally disabled. Otherwise, clearly you would just be totally disabled, right? But the injury or sickness is causing either a significant loss of income or restricting your work capacity. So restricting how many hours you can work, how many days you can work, how many patients you can see in a day. It's restricting your productivity. And that's what partial disability is designed to cover. It's designed to cover the in-betweens. This could come in a lot of different ways. It could come at the beginning of a claim, perhaps something that is progressive, a disease that doesn't appear overnight, but materializes over time. Perhaps even the treatment, something like chemotherapy, may cause the side effects that create the fatigue, create the disability claim, and those don't often happen overnight. Similarly, on the recovery side, right? So we might have something that is immediate overnight, but the recovery requires a lot of therapy. It requires a lot of time. So even though you might be feeling a little bit better, it might take you some time to build back into your practice. And this is really important because it's very likely that you won't be immediately totally disabled and immediately recovered from a total disability. Several policies will automatically include this or pretty much make it mandatory. Some of them offer it as an optional rider. It's something that you want to make sure that you include on a policy because without it, it's black or white. It's either you're totally disabled or you're not disabled at all. And we want to make sure we're covering those gray areas. So these are really, in my opinion, the two most important things that you want to consider. And like I mentioned, they're outlined in the circumstances in which you are most likely to ever actually receive benefits from the insurance companies. Depending on where you are in your career, there are additional riders, just a fancy word for additional features that you can include on a policy to help suit the rest of your career and what your needs might be throughout your career. Again, because of time constraints, I'm not going to get too much into the weeds here. But one thing that you'll hear 1,000 times throughout training that you'll want to include comes by a lot of different names. So again, I'm going to explain it conceptually. It could be called a future increase option. It could be called a benefit increase option, a benefit increase rider. There are at least probably 5 different names that people kind of use to identify this. Essentially, this is a feature that will allow you to increase your coverage levels as an attending and throughout your career. So when you first buy these, if you are buying a policy during training, you're going to be limited to how much you can get for obvious reasons, right? Income is lower. But we want to be able to increase that later on. And most importantly, we want to be able to increase it even if your health has deteriorated in some way over that time. And that's what these features are really providing you. They're giving you the option or the ability to potentially secure more coverage throughout your career without having to disclose updated health-related information to the insurance company. That's the advantage of it. When using these features, your eligibility is based on your financials. So in order to buy more coverage, your income must have increased. The two variables that really affect this are your income and any other disability insurance that you have. So for example, group disability insurance that's provided through your employer will affect the amount of individual coverage that you can get. Another feature that's important, and this is typically based on age, is something called a cost of living adjustment rider. This feature is intended to increase the monthly benefit throughout a long-term disability claim. So if you're 27 or 28, these policies typically will pay until age 65, or if you recover sooner. That's a long time. It's 37 years of a potential claim. And we want to make sure that over those 37 years, your benefit is continuing to increase. If it doesn't, in 37 years, it will be worth less than half of what it started out with in terms of purchasing value, right? Because of inflation. And so that's what this is there for, is to help keep that benefit increasing so that you can still maintain a similar quality of life or try to keep up with a similar quality of life if the claim is prolonged for decades or a really long period of time. This is mostly important if you're young. If you are 27, 30, 35, even 40, I think most people would consider this to be a pretty important feature to include. If you're 55, 60, it's not so important anymore. Certainly it can still provide some benefit, but obviously the risk is not as significant. I'm coming up on my 20 minutes, so I don't want to exceed that. And I want to be fairly respectful of that. I'm going to go over a couple of final things here.
You still have
Applying for disability.
You still have 5 minutes.
Okay, so I'm good.
Yeah. You still
Excellent. Okay. All right. So applying for disability insurance. Applying for insurance in general is not usually fun if your medical history impacts the outcome. This can particularly be frustrating because the insurance companies have a different perspective on medical conditions than a physician will, and then the medical world generally does. And so being physicians, having an advanced knowledge and understanding of some of these conditions, you may look at something and say, that's ridiculous. It's totally benign. This means nothing. Whereas an insurance company will maybe not have that same opinion and will disagree and say, well, you know what, it might be benign, it might not be significant. But if we have 10,000 individuals who have this condition, and then 10,000 individuals who do not have that condition, which group is more likely to go on claim because of that condition? And that's kind of how they're viewing it. So the process of applying for disability insurance can be frustrating, can be difficult. And it's really important to be transparent, be open, and try to figure out if there are opportunities that you could take advantage of that perhaps can help you. Right now, there is a pretty big push for what's called guaranteed standard issue policies. It basically gives you the ability to secure coverage without having to go through medical underwriting. Those are based on your GME affiliation. So any discount, any program that you secure while you're in residency, that carries over with you, but your eligibility for it is actually tied to your GME affiliation. So those are important things to be looking for. But the process of applying for disability insurance, it is pretty intensive. They're looking at everything in your medical history. They're looking at mental health stuff. They're looking at musculoskeletal conditions, cardiac, dermatologic, they're looking at all of it. Overall, the process doesn't have to take that long. Somebody who's in perfect health, can get through pretty quickly. Ideally, this is something that is secured when you're in good health and you still have that. Just because you can lock it in and you don't have to, if you include the right provisions on the policy, you're able to then increase the coverage and maintain that throughout your career without any issues. those were the main things that I was going to cover. I'd love to answer any specific questions that anybody has in the breakout room. Again, disability insurance is very detailed. I could spend 2 hours on this, but I don't want to bore anybody more than is necessary. And I think just kind of scratching the surface does a pretty good job.
Thanks a lot, Michael. Yeah, it's trying to teach this is that's tough, and you did a nice job making it palatable. So thank you. But yeah, there were some people who actually asked questions, and I told them to go in the breakout room and ask you, because I was like, I can't answer this with what's in my brain at the moment, but I'm sure you can. So,
Very good.
all right. Thanks a lot, Michael. We really appreciate your efforts. And so if any of you want to ask Michael more specific questions about disability insurance, you're welcome to join him in his breakout room, and we'll continue with our next part. All right. Anna, I'm excited to hear your part today. So Anna is a certified financial planner. Anna Njai Kante is a friend and expert in financial planning. And this is, for those of you that are starting intern year this year. Oh, Anna, could you turn on your video, please?
So it says I cannot start my video because you stopped it.
Then I'm the one who did it. Okay. Sorry about that.
There we go. Hey there.
Hey, good to see you.
You too.
So those of you that are in intern year now, and some of you who are here, maybe you're, PGY 2, 3, or 4 or whatever, but you typically can't be doing any moonlighting intern year, is my understanding in almost every case. But this might be something that could be available to you, where you could start working, on your resident salary. You're making like $15 an hour, and then all of a sudden, if you can moonlight, you're like, you're making like, could be like $65, $80, $100 an hour, depending on your specialty that you're going into. And that's a really cool opportunity. And I asked Anna to come because when that happens, though, you have to be mindful of the tax ramifications. And so Anna's going to be discussing moonlighting guidelines relevant to cash flow and tax strategies. So Anna, we really look forward to your part. Thank you so much.
Awesome. Thank you so much, Tyler. I just want to give you kudos for doing this, because I know what goes into organizing an event like this. And I also think it's a great service to the community. So big up to you for that. So just to introduce myself, I'm a CFP. I run my own practice similar to Tyler. And I typically work with folks that are self-employed, consultants, things like that. And so this is really my wheelhouse, my jam to talk about. A lot of folks, I think there's an interesting narrative out there that, and I think for in particular for folks in residency, like this is an incredible opportunity for you all to get a leg up financially in a time that might be a little bit financially stressful, right? And so really I look at this as this side income moonlighting, a way to give yourself a leg up financially when we think about the long-term trajectory of your life. And that can, look a couple different ways, which I'll talk about, right? One, it's a great opportunity just to keep your head above water. Tyler, I know a lot of folks get out of residency, they might have credit card debt, and obviously you're going into a field where you're going to be earning good money. But if you have significant student loan debt, if you have credit card debt, like we don't want to add to that. And so, moonlighting is a great opportunity to baseline, keep your head above water. But I also think it's a great way to get a leg up, on your long-term financial health, right? Dr. David Roney talked about compound interest earlier. And, one of the real secrets of personal finance is that the earlier you start, the better off you are long term. I don't know if y'all have seen these internet memes where they talk about, like, if I had known better, I would have started flipping houses when I was in 3rd grade, right? And that's because compound interest and getting ahead of things early really sets the stage, because those small contributions at the outset that feel insignificant to you in the moment start priming the pump for what becomes your long-term wealth building, right? So it's a great opportunity to get out ahead, and I'll talk about that in a minute. It's also a really great opportunity to be tactical around what your long-term financial picture is. So, I just touched on student loan debt earlier. For any of you all who are working at nonprofit institutions for your residency, right? You might not, and Tyler, you might know the answer to this, but do most residents have access to retirement vehicles through the residency, like a 403B? They do,
Yes,
right?
almost
Okay.
all of them, yeah.
And I'm sure that like on $15 an hour, it's a struggle to actually contribute to that. But if you're someone with student loan debt, federal student loan debt specifically, and you are someone who works at a nonprofit, hospital or hospital system or organization, you're actually able to get credit for public service loan forgiveness while you're in residency, right? So you can get credit towards that public service loan forgiveness, provided that you meet all of the qualifications or that are required there. That starts the pump for getting your loans forgiven sooner. And so what that means is, if you're strategic with this moonlighting, you can both meet your current financial needs, start contributing to retirement vehicles because you have that extra income that you're able to use to support yourself and maybe provide a buffer if you're funneling some of your money towards retirement. And the secret of the public service loan forgiveness is to keep your taxable income, your income, as low as possible to minimize your payments, therefore increasing the amount of loans that you have forgiven long-term, right? And so if you're thinking about moonlighting and having sort of that side hustle, that side income, then what you can do is say, I'm going to contribute to a little bit to my 403B at work, and depending on how aggressive and how much you're making in your moonlighting, that's really going to depend on how much you're able to execute on this, right? You contribute some to your 403B through work, through your residency. You can set up self-employed retirement vehicles with your moonlighting income. If it's 1099, if it's W-2, then you might be able to contribute to that as well. That decreases your taxable income. It might lower your payments to just, I've seen folks' payments, depending on their income, go to like less than $100 a month. Obviously, it's going to depend on the loan balance, but it also depends on the income substantially as well. And those payments still count, whether you're paying like $75 or $750 a month, it still counts. And it's a great way to prime that pump. Like I said, start building wealth, start that compound interest clock, and also minimize the amount of time that you're going to have to make payments on those loans, or reduce the amount that you actually end up paying out for those loans. That's just a little tidbit for you all. I think it's also like, so let's talk a little bit about the complicating factors and some considerations you have to have when you're thinking about this, right? First off, I think that, provided that you're able to make ends meet on your residency salary, I like to think of moonlighting as a little bit extra. And a lot of times, and this is really going to depend on the income level of the person that I'm talking to, but I like to say, hey, if you can live on your W-2 salary, so in this instance, it's your residency income. If you can live on that, maybe you need a little bit more for fun things, but I'm just talking about like keeping the lights on, keeping yourself fed, putting gas in the car, the basics. If you're gonna live on that, then you can use the additional income that's coming that might be a little bit more variable to fund, additional savings, to help you pay off debt, to potentially like prime that pump, as I said, towards retirement. You can use it for fun things like going on vacation, going away for the weekend with your friends, right? Whatever that may be. And I think that having it tied to like really concrete goals is really important and helpful. And when we think about cash flow planning, it's easiest to work with the dependable income, the thing that you know is coming week in, week out, month in, month out. Plan for your basic needs and maybe a little bit of your financial priorities in this instance. And then with the additional cash flow to use that for other goals, right? And I typically will recommend to folks to have a percentage allocation approach so that regardless of the amount that comes in, because my assumption is that, if we're thinking about hourly moonlighting, it's not always going to be very dependable how many shifts you're going to pick up and how much you're going to ultimately end up earning with that. And so we're thinking about allocating a percentage so that it's very clear where that's going to go. I'm going to talk about taxes in a moment, right? But taxes is one of those buckets that I always say, like, we're going to make sure that we're allocating towards that, because what we don't want is to get caught up at tax time, and to be really surprised with a tax bill when we have to file our taxes. Another one is fun, like whatever fun is to you, whatever something is joyful or enjoyable to you. And then the next is financial priorities. Excuse me, I have to turn. Sorry, 4-year-olds don't care that I'm on this call. Tyler, you're muted.
No, I was just gonna say I love it when kids pop in on Zoom.
Yeah, she's just like, hey, my iPad died, so what are you gonna do about it?
Yeah. No, wait.
Yeah, it's very important. Anywho, financial priorities, or fun and financial priorities, right? I'm not someone that is all or nothing when we think about like financial goals. I'm not the person that's going to tell you to save every dollar or to be like super strategic and super lean with your budget so that you can maximize the financial return, right? Y'all have been working hard for a really long time. You have been putting in a lot of hours. Like, I know becoming a doctor is a grueling process. And so I think it's important to allocate a percentage and give yourself permission to know that this is going to go for my enjoyment because I'm handling my other bases. And also that's self-care, right? So then just that little disclaimer here, put a percentage up for fun. And then financial priorities, whatever that may be. I just, one thing I'll share is, I have a financial priority list that I'm happy to share with anybody, that I typically will tell folks to kind of go through as they're going through their financial journey. And so I'm happy to share that if y'all need some guidance or some ideas. I know Tyler's going to talk about creating your own financial plan. This could be additive to that, but I'd love to share it. But like the first is, hey, put a month of expenses aside, right? So that if there's some drama, your moonlighting is low, like, and that cuts into your income, you're able to continue to meet your basic needs, right? Your car breaks down, whatever that is. Keep that separate. Then, we want to look at high interest debt and maybe tackling that off, contributing to retirement, beefing up emergency fund, and so on and so forth, right? But I'm happy to share that with anybody who's interested. Go through that list, and then you can see, like, all right, as you're allocating that percentage of your moonlighting income to your financial priorities, you can kind of go through that and decide. And obviously, this is very general set of recommendations, but it's in a decent order to whereas if you follow it, you're going to be in pretty good financial shape, candidly. Last thing I want to talk about, everybody's favorite topic, is taxes. And what I often find, I have lots of doctor clients. What I often find is, they will do locums, they will do moonlighting on the side, and then they are very surprised, extremely surprised when they have a big old tax bill. And it's because they're not keeping in account the fact that when you are moonlighting, and I'm assuming that's mostly 1099, meaning you're not getting a paycheck. They're just direct depositing money into your bank account, whatever that bank account is. They're not accounting for taxes the way that your job is for you, right? Like, there's no W-4 form that you're going to fill out to say how much federal and state or local taxes that you want them to have withheld. And so the responsibility is on you to ensure that you are putting that money to the side. So if you're getting, let's say, $1,000 a month of moonlighting income, that $1,000 is not just yours, right? It's a portion of it has to go to Uncle Sam because, he needs his cut too. It's not just yours, as much as it feels nice to see that big number every month. So, there's a couple of guidelines I'd like y'all to know. One is, don't worry about the IRS coming for you. Y'all are not committing tax fraud, right? Like, nobody's going to put you in jail if you have to go on a payment plan with the IRS because you messed up the calculations for this. That's one. But I think one of the things that we want to do is try our best, even if we under withhold a little bit or we don't make estimated tax payments to Uncle Sam for like that additional moonlighting income that we're having, that we stay within what's called safe harbor, right? And so safe harbor is basically if you pay in, and this could be through your W-2, this could be through like you going onto the IRS website and making estimated tax payments on a quarterly basis. If you pay 90% of whatever your tax due was last year, you're good. You're not going to incur penalties. And it's one thing to owe money to the IRS. It's another thing to owe penalties where they basically penalize you for not paying throughout the year and not paying sufficiently throughout the year. That's something that can be easily avoided if you're running calculators, if you're, doing some tax projections, if you have a good tax preparer, or if you're on TurboTax, like they'll tell you what your withholdings should be and what your estimated tax burden is, like go off of that. Or if you are doing 100%, oh, sorry, excuse me, it's 90% of the current year, 110% of the prior year. Sorry, I made a mistake there. I always get that mixed up. Anywho, that's really important for making sure that you don't have any extra fees. If you're putting in all this work, like why give extra money to Uncle Sam? There's no reason. So what you really need to keep in account with this income that you're receiving is that you are going to owe federal taxes, potential state taxes, and not just federal income taxes, but you're going to owe federal self-employment taxes, which, is that payroll tax that you see, like the Social Security tax, the Medicare tax that you see on your pay stubs. You have to pay that as a business when you're doing this 1099 work. And the funny part, or not so fun discovery of like doing moonlighting, is that your taxes actually increase because your employer, when you're working as a W-2 like employee, as you would be with your residency, they're paying half of that like self-employment or payroll taxes for you. And so your tax on that portion of things instantly doubles. So I have an example here. Let's say somebody earns $75,000 in a year between their job, like their regular job, and they earn that on and they earn some 1099. Let's assume that they earn $50,000 from residency and $25,000 from moonlighting in a year. For anybody, the standard deduction, and everybody gets that, is $14,600. So that instantly reduces their income to around $60,400. At that rate, if they're single, they owe 22% federal income taxes on a portion of that, and it's not all of it, but they're going to owe 40. They're in the 22% marginal tax bracket, so they're going to owe 22% on anything above $40,000, for roughly 40. They're going to owe 5.5% New York State taxes, assuming they're a New York State resident, right? And then they're going to have self-employment taxes of 15.3% on that 25,000 moonlighting income, which my calculation was that closed 25,000. So they're going to owe 15.3%. So that's $3,825. So in total, they're going to owe around $20,435 in taxes. That's going to be some from the W-2 withholding. That's going to be some from that they might want to do estimated tax payments for their moonlighting income, right? As a general rule of thumb, obviously everybody's income is very different, but I think if you are in the practice of anytime you have some 1099 income or moonlighting income, putting 20 to 30% of that money to the side in a separate bank account and leaving it there and making your quarterly payments to Uncle Sam, whether that be federal or state, you're going to be in a really good position. You might get some of that money back at tax time. You can have a tax professional help you, but I think that will get you in the habit. And I know that it's very tempting to put that money to the side and maybe dip into it when if something goes left on you, but I really want to urge you to keep that sacred. That is not your money. Imagine Uncle Sam gave you a check and said, hold this for me. If your dad gave you a check and said, hold this for me, you're not going to go spend it, right? I don't care what's going on. And so, or maybe your grandmas are like, we protect grandmas around here, right? Like grandma gives you a check and says, hold this for me. This is my Social Security check. You're not going to spend grandma's check. Putting the tax money aside is the same thing as that. Anywho, I hope that was helpful. Tyler, you went from disability insurance to taxes. God bless you. God bless all of y'all for listening to those two things back to back. It's about as dry as it gets. But I hope this was helpful.
Hey, Anna, we had a question, if you don't
Uh-huh.
mind, before we go to have you go to your breakout room. I thought it was a
Okay.
good question. Someone said, when you make quarterly payments, what do
Mhm.
you mean and how do you do that?
So, quarterly payments are, you can go, so the website, I can't remember what the IRS website is, but it's basically a place for you to pay your taxes. So when you get your W-2 paycheck, let's say your gross pay, I'm just gonna use round numbers, is $1,000. And so let's say 25%, you've opted for 25% of that to go for taxes, right? Your employer is gonna take $250 of that and they are going to pay Uncle Sam for what you think you owe, and they're going to only deposit $750 to you, right? So when you're moonlighting, this is essentially you doing that for yourself, with cutting out the employer as a middleman, right? Because you are entering into a contractor relationship, and that shifts the burden of making the tax payments and being in tax compliance to you as the self-employed person. You just go, they're done quarterly, so it's April 15th, June 15th, September 15th. Is it October 15th? I made that up. Is it June? It's June 15th, October 15th, January 15th. Those are
So,
oh, go
so
ahead.
it's so April 15th is January through March.
Mhm.
Well, I'm going to say it a different way.
Yeah.
January through March has to get paid April 15th.
Mhm.
April and May gets paid June 15th because it's like a 2-month quarter, which is stupid, but that's just how they do it. So April through May gets paid June 15th. June through August gets paid September 15th. And then September through December, a 4-month quarter, gets paid January 15th.
You're right. Thank you, Tyler. And so it's up to you to make those payments. And most states follow a similar cadence as the federal government does as well.
Cool. Cool. Thank you very much. I think that was, yeah, so that was the main one I thought we could answer here. Thank you so much for sharing some of these thoughts. It's very complex, and you taught it very simply and in a way that's understandable. So thank you. I really appreciate you coming, Anna.
Thank you. It's my pleasure.
So if you have a few minutes, Anna,
Yeah.
have you go to your breakout room, and anyone who wants to
Perfect.
ask Anna any additional questions, it could be about taxes or anything else in financial planning realm, I imagine. So you just move yourself over there, and then you can you can talk there. All right. Our next speaker, Dr. Tarang Patel. Thanks for coming on. I appreciate your willingness. This next thing is a very important topic. You definitely are keeping me on my toes as a financial professional in my field. I like online you push back and it's good. It's very good. But I've noticed too that you have some things to say about the physician finance space and some of its own unique conflicts of interest. And so for all of you who are, you just matched the amount of solicitations for insurance and real estate and investments and all sorts of stuff, it just keeps coming. And so what Dr. Patel has to share with you is really, really important to protect yourself. So Trang, please go ahead. We're looking forward to it. Trang, we can't hear you.
Okay, can you hear me now?
Yep, we can hear you.
Sorry about that.
No worries.
My AirPods just stopped working, so I will adjust that. Take them out. Okay. So I'm trying to share my screen here because I have a little slide deck here. Can you guys see any of that slide?
No, it's not being shared yet. You should be able to. Oh, it's coming up now.
Okay. Perfect. All right. So we will play this. Okay. All right. Is it going?
Yep.
Hello? Okay. All right. Sorry. Okay. Thanks, Tyler. I want to appreciate you doing this. I wish someone would have done this for me when I was a graduating medical student. And I hope all the participants, I'm sure they do appreciate all the work that you've put in and all the presenters also. Yeah, one of the things, so let me introduce myself. I'm Tarang Patel. I'm a radiologist in Arizona. I used to do a financial podcast for physicians a few years ago, and I stopped right before COVID. Probably should have kept it going because that was a big time for financial fraud. Anyway, so I've been interested in finances for a while, and so I decided to do a podcast and kind of teach some of the topics that they didn't, I never learned about in medical school. I've hunted, or I felt like as a graduating physician, we were hunted by about protecting yourself from financial predators. But as Tyler indicated in the intro, some of those predators are our own physicians. So, it's not just external to us, it's also internal. Go to the next slide here. So I want to say congratulations to all of you. Finishing up medical school is an incredible achievement. I know how long of a process that is, and how much it feels like it's an arduous task, and it is. And let's not minimize it. So I want you to enjoy the next few months. If you have some downtime, learn some non-medical stuff. Talk to all those people that you haven't seen over the last few years, because things get busy again starting in July, as you are all aware. Plenty of time to work later.
Hey, Tarang.
But the long road does continue. Finances, much like it's a long road, and you have to stick to a plan. Just like that first anatomy test back in your first year med school was kind of a shock. All these financial things that we're talking about and all the speakers have been talking about it's a lot. But you got through it, and you'll get through this. The good news is no one's testing you directly on it, but there is a final exam, and that is your finances. So the better you do, the more you understand, the better you'll do. But the good news here is if you make a mistake, you can recover. So, and no one's going to criticize because we've all been there. We've all made mistakes. And there's no one size approach for everyone. Your best advocate is going to be you, not your financial advisor, not your family, not your friends. They can be helpful, and in many cases are very helpful, but you are your best advocate. So I show this picture of a road to indicate the long journey, but let's talk about compound interest. That's a long road. Dr. Roney talked about compounding in the sense of debt. One of the positive things about compounding is that it works in your favor, but it doesn't work very quickly. I did this little slide from investor.gov, which is a very useful website. If you have a chance, you can play around with some calculators on there. So the long road part of it is the earlier you start, it's amazing, but it takes a long time for you to actually see any impact from compounding. Much like a diet or an exercise plan takes a while. The first part of it is just you sticking with it, and that's when I stick to a plan. So year 1, 2, all the way up to year 10, these lines kind of just basically overlap. The red line here that goes up exponentially is what compounding does. The straight line here is what your contributions are over time. So I set this up as contributing $1,000 a month, which is probably not something a resident's going to be able to do, but maybe as an attending you might be able to do that after a while. But I just did it just to do numbers, but the principle holds no matter which way, what numbers you put in. But you don't really see that divergence until about year 10. So this is all your money that you've put in, and you're not really seeing a ton of work happening until about year 10. Finally, this is a year kind of, year 0 to 10, we like to consider early career physicians. Year 10 to 20, we consider as mid-career and 20 plus more senior physicians. We all want to get financially independent early, but it is a process. So around year 10 to year 20 is where you start seeing that compounding work for you. But the main magic of compounding occurs every year after that. Year 20, 25, 30, 35. Warren Buffett, who you probably have heard of, is one of the richest men in the world, one of the greatest investors of all time, worth about $100 billion now. But 95% of his wealth was earned after the age of 65. He's 93 now. Probably 90% of it was earned in the last 10 years. That's just how compounding works. So it's a long process, but it can work in your favor. And there's a famous quote about people who understand compound interest benefit from it. People who don't pay it. So put yourself on the right side of that quote. The earlier you understand it, the earlier you can kind of implement one of these plans, the better off you're going to be. And this comes to the financial industry. So historically, financial industry used to charge, a percentage of your income. So that, or a percentage of your assets. So that used to take away a little bit of your earnings over time. And again, if you go back, the divergence on that red line that I showed you was amazing. That's what financial industry will show you. But they rarely will show you the impact of their fees over time. So this is a calculator from Schwab, and the whole thing couldn't get on there because of the format of this presentation, but it basically follows the same path. But the yellow line is the impact of 2% fees. The kind of brownish, darkish line here is the impact of 1% fees. And the blue line is the impact of 0.2% fees. So the fewer in fees you pay, the more you keep over time. And the example I used was the same number, and it made a $400,000 difference between what you get at the end of year 30 with the yellow line versus the blue line. And the blue line is what you want. So minimize your fees, and that'll help you in the long term. But don't take that to mean I don't advocate financial education or a professional finance person to help you. Just keep in mind that over time that can, deduct from your own financial growth.
Hey, Dr. Patel,
So have I made mistakes? Absolutely. Here's an actual picture. Yes.
Your
Hello?
yeah, your slides are not like moving forward. Like the video feed is slow. I was gonna suggest you turn off your video and see if that helps us to be able to catch up to the slides that you're showing us.
Sure. Okay. Sorry about that.
That's all
Let
right.
me just go back one here. Oops.
Tech is tough to
Yeah. Okay. So did you see these? Sorry.
right now we're looking at protecting yourself from financial predators. There's a calculator or a stock, there's like a stock app, and then there's a lion.
Okay. It says, oh, you know what's happening? It says my screen sharing is paused. I'm not sure if that's on your end.
It says, let me, you know what? And actually someone suggested maybe escape screen share first. I'm going to stop you participating, sharing, and
Okay.
you could try again.
Okay. Sorry about that.
No, it's okay. I appreciate your pivoting. Are you still there?
Yes. Let me try to share again now here.
Okay. In the meantime, you all get to just look at me.
It's not giving me the option, Tyler, to share the screen.
Okay, here, let me
Oh wait, nope, there it is. Sorry. There we go. Okay.
Okay.
Got it. Let's see. Okay, how's that?
it is starting to share. Now we're looking at Long Road Continues.
Okay, all right. Let me go back. Here we go. Good. Okay. So, okay. So did you see the long road that I showed? Okay. So here's the long road.
Yeah, go
And it's a
ahead.
long journey, as we said. I'll just kind of speed back up through it. So this is the compound interest growth that the financial industry generally shares with you, and I agree with. The red line here is the compounding over time. This bluish line here with the diamonds are what you put in over time. So the exponential growth occurs towards the end, but it's extremely powerful. But it does require discipline because it takes a while. As I said before, you don't see much of a difference the first 8 to 10 years. There's very little delta here between the two lines, but that increases, and the longer you go out, the bigger a difference it makes. So that's the powerful part of compound interest. But the negative side of it is the fees, the debt, as Dr. Roney talked about earlier. The more you can minimize the fees and costs, the more your blue line, which is the growth with minimal fees, versus these other two lines, which is intermediate amount of fees and kind of a high amount of fees. The more you can, minimize those fees, the more you get to keep for yourself. So ideally, you want to be closer to the blue line, because over time, when I use an estimate of $1,000 a month, starting at zero over 30 years, the difference between 0.2% in fees versus 2% in fees, and that's a high amount, but I've heard of it, is 400,000 in return. So the total you would have made was 1.3 million versus 900,000. And those numbers are not as important, but you can see that 900,000 versus 1.3 million, that's almost a 50% increase that you would have kept for yourself. So just the key part is understanding the impact of compounding and then understanding the impact of fees. Have I made mistakes? Absolutely, I've made mistakes. This is a picture of my alma mater, Indiana University. And a couple of years ago, at the opening game of the football season, one of the players came out with Indiana spelled incorrectly, and it made it kind of viral on social media. And we all make mistakes. I'm sure the person who spelled that didn't keep their job at Adidas for too long, but unfortunately, mistakes happen. So my mistakes were buying a home right after residency at the peak of the last housing market, 2006. I was out of training. I was in the Air Force and moved to Las Vegas, the epicenter of the bubble, and bought a home that was probably, it wasn't out of my reach, but I thought the price was too high. Well, I was right. 4 years later, I had to sell that house when I went to go for a fellowship at a 70% loss. I've invested in startups without really understanding what they were because other doctors near me in my area were also investing, and I didn't want to have FOMO. Most recently, I invested in real estate just before the pandemic because I felt like I was too heavy in the stock market, and people were talking about real estate. I'm like, okay, let me look into some syndicated real estate deals. And I didn't understand that a doctor who was telling me about the real estate was actually financially benefiting from trying to get me involved in the investment. I've made mistakes, but I'm doing fine. We can recover as physicians. You'll be able to recover, but the more you minimize, the greater your chance of success on the financial journey will be. So I'd like to, the biggest risk though, as a financial for success is your behavior, and it's getting tougher out there. The financial industry wants you, and I'm not talking about financial professionals like Tyler or the other presenters on this program, but in general, the more you use financial apps, the more you participate in meme stocks, the better off it is for them. So many of you may remember from a few years ago, the GameStop saga, where people were talking about their investments on Robinhood, on Wall Street Bets via Reddit. And some people were doing amazingly well. I think there's a Netflix movie about it now. but the vast majority of people did not do well. The vast majority of people lost money, and there were some people who were really financially hurt. As I said at the beginning, it's a slow, steady race. Don't worry about making a ton of money right away. You're not in it. You've already gone through, you are going through something that takes a lot of discipline. So you are in better position to maintain that level of discipline across your life. So I highly recommend that you don't take big bets. Doesn't say you can't take any bets. You still have to have fun, and don't discount having a good time. I'm not saying you should go out and just live a miserly life at all. By no means. We all know that outside of medicine, we have to have other interests and things like that to have a well-balanced life. So don't struggle too much in residency, but know that over the long run, the discipline will pay off. There's a recent Wall Street Journal article about a psychiatrist who she's an addiction psychiatrist, and she was lured in by some of these online casino apps. And in her state, they're legal, and she got in some significant financial difficulty, hundreds of thousands in debt, even though she understood the psychology of addiction more than almost anyone. It makes it very difficult. So the best way to deal with your finances are realize that that part of your life is not a game. Just stick to it the way you would tell your patients to stick to a good diet, to exercise. Your finances should be in that realm as well. Boring has a much better chance of long-term success. And I missed this slide, but it was just that there are new products designed to create short-term thinking, and the best defense you have is to continue to think long-term. This is the meme that went around during the Reddit Wall Street Bets thing that was talking about diamond hands, and this is supposed to show the financial industry profiting off of the majority of the people who were playing the meme game, the meme stock game. So again, you are a target. Financial people in general still think of physicians as targets. By that I mean we make especially early career, post-residency people, but even during residency, you will be reached out to. You're going to be making, once you get out, you're going to be making a pretty significant bump in your income. And you are their professional athlete. Everyone wants to invest with NBA and NFL players, but there's not that many of them. So you are the most accessible high-income people for most people around you. And then if they get with you early, they tend to have a person with them for a long time. So get with good people early, and then you can stay with them. These are ads. I'm going to just scroll through a bunch of these. These are ads that were pitched to me on social media as a physician who's interested in finances. So I'm sure I'm targeted a little bit, but some of them are just kind of ridiculous. You see these big numbers and you're like, wow, 38 to 50% target IRR, internal rate of return. And look at this at the bottom here. It says, we do all the work and send you a check. What a dream. Fantastic. I don't have to do anything. Sign me up. But in reality, it's never going to be that easy. Here's another one. $200,000 minimum investment. Join other elite doctors in passive investing into the QC car wash fund. Wow, elite doctors. 200,000 passive income. Sign me up. Sounds amazing. It's usually not, especially what's happening on social media. Here's some more. Here's an interesting one. A picture of a female physician on a beach. Looks like she's wearing a really fancy lab coat. Well, hey, I don't want to work on when I get older. I don't want to work now. I can sit on a beach with my practice. That'd be fantastic. Sign me up. Now, be skeptical. Be really, really skeptical. Always ask yourself, why am I being pitched this product or this investment? And know that it's not just the financial industry. There are countless other physicians who are pitching investments, courses, tons of things, retreats. Some of them are good, some of them are not so good. but you are no longer just a colleague and someone that you're going to be, that they're going to help educate. I mean, they may help educate you, but you are also a profit center to many of these people. And so just remember that. We tend to trust other physicians. There are some massive physician-run social media groups that make insane amounts of money. And that's fine if they make money, but up until recently, many of them didn't disclose what kind of affiliations and what kind of money they were making and how. And I think you need to realize that. Some of them will pitch you good people who are mortgage lenders or good financial advisors or good disability insurance people. And they may very well be good people. But realize that they're also probably getting affiliate income from some of those people. So just always understand the psychology and the incentive of people pitching you investments. Again, boring tends to really work over the long run, but boring is not what gets talked about on social media, and boring is not what gets talked about when you're going out with your friends. It's usually what's hot right now. So it's not, just stick to a small percentage of what's interesting, what's popular. The vast majority of your finances should be boring, safe, and something that you really don't need to talk about. And you just need to consistently put money in, and over the next 20, 30 years, you're going to be incredibly surprised how well you do. So finally, who can I trust for finance? Trust yourself first. Well, trust your dog, but unfortunately, dogs, while we can trust them, not so great at finances. But generally, finances are not that difficult, at least the basics of finance. You can get into crazy in depth in so many things. You don't need to, though. So first, trust yourself. Trust financial professionals sometimes. I've said before, and Tyler and the others will attest, there are many of their colleagues who are not so great. There are many of their colleagues who are great. Use your own instincts when you're talking to these people. Are they pitching you something? Are you soliciting them to get their expertise? Always trust your own instincts first. But then there are good people, use them, use the resources. But remember, you don't need to use them forever. Learn what you can, and then try to do it your own. And if you don't want to do it your own, don't feel comfortable, use someone who charges you a fixed amount instead of a percentage of your assets over the long run, because that will cost you dearly in the long term. Trust your colleagues, maybe. The worst offenders and the stereotypes are the stock tips you get in the doctor's lounge, if you even have doctor's lounges anymore. But sometimes you can get some good information. So always do your research in those. But I would say err to the caution of not really listening to other doctors in these hot investments. For good overall behavior, great, but for these hot investment ideas, doctors are notoriously bad. And then trust social media stars. Well, probably not. Even the financial media, social media superstars have some really good ideas, but they're, you can take some ideas from them, but you don't have to trust everything they say. Dave Ramsey pitches a lot of stuff that isn't really very good. I wouldn't, but that doesn't mean that his advice on paying down debt is bad. So just take that in bits and pieces and understand who you're getting your information from, and where are they making their money from. And then finally, I just have some resources here. I still have the podcast, and I cover a lot of topics that you may have had before. I haven't done any new podcasts in a while, but certainly feel free to go over any of those you want. And there are plenty of other podcasts. Tyler had the new one. Boggleheads is a great resource. That's what I used when I was first starting out, and they have a good wiki about when you're getting started. Dr. William Bernstein is a neurologist who is also an extremely eloquent financial author, and he has written many large books, but a small free book that he has is a good one for starting out, called If You Can. Ben White, who I think Tyler's talked to before, does a good free book on his website for student loans. It's a good one. And then investor.gov is a good website. And then just one more thing, a couple of books: Psychology of Money, Poor Charlie's Almanac, and then one video that I highly recommend that you watch. And it's really just audio of a speech from Charlie Munger, who was Warren Buffett's partner, who just died recently, about how we are prone to not understanding our own biases and our own errors. extremely useful. It actually really opened up my eyes to a lot of biases that I have, and failings that all humans have. It's on YouTube. It's called The Psychology of Human Misjudgment. Sorry for the technical errors, and I thank you for bearing with me.
It's totally fine. I mean, things happen with tech, but everything we got to be able to hear a lot of your thoughts, and I appreciate your candor. Without, yeah, I know you're trying to present something balanced, because it's easy to have extremely strong opinions in one way or another, and
Right.
I appreciate how you are trying to advocate for your colleagues, because man, I remember when I when I first got into the industry, I worked at a firm that was primarily asset management based, and we also like sold insurance and stuff too. And just the idea, they're like, oh, this person's a doctor, like you got to get them, like they're going to be a great client because they make tons of money, and you want to, if you do end up working with someone, you want to get the sense that they see you as the person that you are, and that's not always easy to find. And and of course the expertise too. So yeah, yeah. Thanks a lot, Trang. I appreciate it. And so if any of you would like to if you'd like to ask Dr. Patel any additional questions, there's a breakout room with his name on it. You're welcome to move yourself over there. Um, and then we'll continue with our next part, which is actually the last part. Let's see. And I saw that there were a few questions that were asked about PSLF, and then I see this one about financial advisors that charge a percentage. Yes, so there is, yeah. So I'll be sure to address those things. The first, though, I'm going to share with you the concept of creating a financial plan. And as a financial planner, I do this on a regular basis. And so what I wanted to do is talk to you about this, because Tuesday, yesterday, and today, we talked about a variety of topics. And one of the major difficulties with being able to put forth the effort to make good financial decisions that work together in concert is organization. Having things in a place where you can access it, recalling the decisions that you've made, and ensuring that the decisions that you are making about debt and investing and insurance, that they all are working together as well as possible. Now, that last bit about like figuring out how they work together, we talked about, we talked about a variety of things about like paying off debt versus investing, and everyone's situation is a little bit different. So that piece is probably the hardest one to figure out. But while you're in training, there's not a lot of factors. There are some things, but the main focus, and this is my personal opinion, the main focus should be making decisions that are going to help you to maintain good health and good relationships and focus on your training. Wealth creation, debt payoff, those are excellent goals later. Now, if you are in a household where your spouse earns a lot of money, or you have family members that are financially supportive of you, then maybe whatever debt you have could be paid off. So I'm not saying it across the board that no one can pay off debt in residency, but most cannot. And if that's you, that is just the process. And it has nothing to do with whether or not you're being wise enough with your own funds. It's just that your income, $3,500, $4,000 a month, it only goes so far. And so paying off private loans, credit card debt, let alone medical school tuition, it's just not in the cards right now. And it's okay, because those things will come later. So within the framework of managing money on a month-to-month basis, trying to save some money in case emergencies happen, and getting into a routine of investing in your program's 403(b) plan or potentially a Roth IRA of your own. Those are all goals that you can modestly work toward. And, but it just has to be within the context of your own circumstances, because wherever that paycheck is going, however much rent is, and how it's how much it costs for you to live where you're at, how much money is reasonably left over, that will result in varying end results for each person in different areas. So, but that's a little bit about how these things work in concert. But as you have all likely taken some notes on these different topics of insurance, budgeting, taxes, it's really important to put it into a organized fashion. And so I wanted to share something with you to that end. If you look here at this document here, this is an example of a sample financial plan. Because people ask me, they're like, well, what is a financial plan? And it's like, as far as the document itself, it's a writing down or typing up of things that you either did or things that you need to do, or a combination of the two. And that it varies. Like the plan documents that us planners make, sometimes they're very simple, like lists like this. Sometimes they have more things included, like related to like your taxes or your investment performance or your net worth. And those metrics, those can matter. They do matter to some degree over time. But for right now, you just need a task list. What do I need to do in order to be financially stable as reasonably as I can while I'm in training? Well, this is an example of what you could do. So what I did with this example is organized it into subtopics: federal student loans, private loans and credit card debt, insurance, employer benefits, cash flow, emergency fund, investing, and estate planning. And you don't have to try to like jot all this down or anything, because you can access this in the resources tab. I wanted to make this available to any of you who would like to use it. I'm a big fan of checking things off, and so we have a checkbox. So as you are reviewing what you have learned these past 3 days, look at what you need to do. If you have federal student loans, you have 5 major tasks that you need to address in order to manage those loans during training. You need to electronically file a tax return. If you're married, comparing filing jointly versus separately to know if like the tax liability difference matters, versus like raising the payment amount, as Andrew spoke about on Tuesday. A consolidation application at studentaid.gov after graduation. That gets your PSLF payments qualifying as soon as possible. And then you're going to select, most likely you're going to select either save or pay. Now bear in mind, pay will not be accepting new borrowers or new applicants after June 30th of this year. Now you could go into IBR, which is very, very similar to pay, if you don't think that you should go with save. And just a reminder, everybody should go on save unless 2 conditions are met. 1, you are really confident that you're going for public service loan forgiveness. And 2, your post-training income is $100,000 or more greater than your debt. So if you've got debt of $250 and you think you're going to be making $400 and you're going for PSLF, you should probably pick pay, because save will get really expensive after training. But see, even that is not necessarily the case across the board, because like say you're going into neurosurgery and you're going to do a fellowship and you're in training for like 9 years, You could be on save that whole time, and year 10 is still going to be based on year 9's income. So it wouldn't even matter what your post-training income is going to be, because by the time you get to the 10 years, the income that you're factoring in is still your trainee income. So in many cases, save is the right choice. So organize your plan so that you have these steps figured out, and then move on to private loans and credit card debt if you have that. And the main thing to do with this kind of debt is to refinance to a lower rate if you can. So if you got high interest credit card debt, then of course refinancing is a good idea. But you want to make sure that you choose a term where you know the monthly payment is something that you can actually meet. So understand how long this loan is going to be going on, and what the payment will be. And then you got to factor that in to your cash flow or budget plan, which is one of the other subtopics. And then insurance. As we learned yesterday from Dr. Turner, and today further with Michael Relvis, GSI, or guaranteed standard issue policies, are something you want to look for. See if your program offers it. The resources page on the olsonfp.com website gives you a pretty long list of programs. I wouldn't say that it is completely exhaustive, because there could be new ones, but you could check out the resources page there if you want to check to see if your program offers it. Apply for it, because at least you want to get covered. Like Jimmy mentioned yesterday, you don't want to get in a situation where you get denied coverage and then you can't get anything. And then the next step further with disability insurance is to connect with an independent agent who is able to sell policies from the 5 major insurance companies that offer excellent policies: Emeritus, Guardian, MassMutual, Principal, and the Standard. Get quotes. Doesn't mean you have to buy them, but just like get quotes so that you know what it's going to cost to get a true own occupation policy of your own to supplement what your group coverage is offered through your program. If it's affordable, you could get the disability insurance. And as far as other insurance decisions, get term life insurance. Probably going to cost you around $30 to $40 a month for $500,000 in coverage on what would be called a 20-year term. So that policy would be good for 20 years, which is quite a bit of time for you to get out of training, start earning a lot more money than you are now, and actually investing and building up your net worth where you wouldn't need the life insurance anymore. And then umbrella insurance, where we discussed that too, where that's a supplemental form of liability coverage that goes above and beyond your car insurance and your homeowner's insurance. Because as physicians, you are targeted, as far as like any sort of accidents that happen. People might think that you've got a bunch of money, and even if you don't, it's such a it's a headache to have to deal with fighting. If you have an umbrella policy, you are covered for much more than the $300,000 limit or $500,000 limit of your car insurance policy or homeowner's policy. So then check all these off. Just make sure that you've addressed them in accordance with your circumstances. Employer benefits, making sure that like you understand the PTO, paid time off policy with your program. Now's the time to like look ahead and be like, when do I want to be able to take some time to visit family or visit this place to get some refreshment? You're going to have an opportunity to earmark those times off and make sure that you do that, because it's really important to take care of yourselves. I hear over and over again that intern year is really challenging, and I know it's all probably for very very good things that you can learn a lot, but you need to have the opportunity to rest, and if you're given that chance, you want to plan around it. And then other employer benefits, health insurance coverage, as related to your personal disability insurance. If you talk with an agent, you should inform them of the group coverage that's offered through your program. And then some health insurance coverages offer HSA or FSA. Those are ways for you to pay for health expenses or even childcare expenses with money that has not been taxed yet. So see if like your program offers those types. HSAs are great because the money rolls over year to year. And then there's often many optional benefits too, and you want to look at them and see if there's any that would actually be particularly important to you. One that I discourage commonly is getting life insurance through your employer. It might be a little bit cheaper, but it'll only last as long as you're working there. And getting your own personal term life insurance policy is not inordinately expensive. So I generally recommend not getting life insurance through your employer, but just getting your own. And then the next section is cash flow. So you want to make a budget of your income and expenses, and you can use the spreadsheet that Valerie shared with us on Tuesday. That's in the resources tab. I've asked Anna if she could email me the financial priorities resource that she mentioned, and I'll be sure to put it in with I don't know how I'll put it on the resources section of the olsonfp.com website too. So that'll be there eventually. Nevertheless, you want to make a budget so you know where, your income coming in, spending, going out. You could use paper, spreadsheets, software. Monarch is a good option as far as software, as is YNAB. And so then once you do that, you can check it off. Of course, I'm sure many of you are looking for places to live right now, so you might not know all of your expenses yet, but just leave that as a to-do, and it's not checked off yet. So once you get those gaps filled in, then you can do that. And then you want to look at your spending. Once you see what your expenses are, evaluate your spending. Save if you can. If you see things you're like, why am I spending money on this? I don't need to do that. That's not making me happy. It's not giving me refreshment. And on the other hand, there might be things that really are and that you should spend money on. Because as I've mentioned before, this is not the time for you to be saving every penny that you can. If you need to spend money in order to be yourself, to be human, to be okay, to be healthy, to be able to have time with loved ones and friends, and that requires some money, you got to do it. You got to, and you can't be spending so much, that you're just mounting up credit card debt that is unmanageable. But you do want to, it's okay to not be saving a ton of money every month, because we want you to be well. We'd rather that than you not be doing well and have a bunch of money in the savings account. If that's, if all other things are equal. The next section is building up an emergency fund for things that come up. First, aim for saving $1,000 in cash. Then build toward 1 month of expenses, and then eventually 3 months of expenses. That last one may not be doable for many who are in residency, because it's just a lot to save. And you don't have to build up all that emergency fund before you start contributing to your employer's 403b plan or a Roth IRA. You could do a little bit simultaneously. But it would be good to have like $1,000 in cash saved up before you start doing like Roth IRA investing. I will say that when you start your job in July and you have the option to opt into your 403b plan, that comes from your paycheck and it's automatic. Especially if your employer offers a matching contribution, I would get going on that right away, because it's essentially a slight pay bump. So take advantage of that. And then lastly, estate planning. A lot of people say, like, what do I need that for? I don't have a lot of assets, or I don't have kids. You should still have a will written, because a will that's written properly is going to include living benefits, as noted in part 2, financial and health power of attorney, someone that can advocate for you if you are incapacitated and unable to make financial transactions to pay bills, but you're still alive, you're in the hospital. Someone's got to be able to do that. And if you have these in place, a family member or friend is not going to have to get a court order in order to log into your bank account. So you want to get these sort of things taken care of, even if you don't have a bunch of assets, even if you're single. Now, if you are a parent, it is really, really important that you do this, because you want to have successor guardians in place. So it's a terrible conversation to have, because who wants to talk about you being gone and your kids having to be taken care of by somebody else? But it's so important that you and your significant other, if if you two are making those decisions together, that you could intentionally choose who would be right to take care of our kids if something happened to us, because you don't want to leave it up in the air. So all of these things go into estate planning, and so it's really important to get that taken care of. So writing a financial plan is not just this, what I shared with you. Everyone has nuances and details about their life that are going to be unique to you. But this is a good starting point, because a lot of people are like, well, what do I need to do? This is what you need to do. You need to work through your checklist. If you can knock out a bunch of these things and you just keep working through it as your circumstances allow, you'll be on the right track. And because a financial plan is essentially saying, like, what decisions have I made? What action do I need to take? And then as your life changes, as you get to the end of training, you're deciding if you're going to apply to a fellowship, these factors will change. And then you can adjust the decisions that you are going to make successively. So, this document's available to any of you to use. And I hope that you find it helpful. So that's what I wanted to share with you. Now, I did want to address some questions. Oh, Steiny answering the question about the millionaire as a physician in the 50s. Yeah, go ahead. That's a good one. That's a good question. So just to clarify, someone was asking about PSLF. So I'm going to go through these questions. Applying for PSLF is a 10-year process. You don't actually apply for PSLF until year 10. What you're doing right now is you're taking the steps to put yourself on the PSLF track. So what you do is after graduation, well, actually, let's go back up here to the federal student loans section. You file a tax return, compare, whether you should file jointly or separately, do a consolidation application after graduation, select save or pay in accordance with your federal student debt and your post-training income. And then every year you're going to file an annual employer certification through the PSLF help tool on studentaid.gov. If you do that, that will get you on track for PSLF. And then after training, if you're going to continue working in the nonprofit sector, then you'll continue doing these things, updating your income, submitting an employer certification. The certification for the employer, that's basically them verifying to the Department of Education that you are working full-time for them and that they are a nonprofit organization. So there's that one. And you want to do like these things, the consolidation application after you graduate med school. So I do it, late May, early June, as soon as your school updates your status as graduated in the National Registry. Where can we go to calculate simulated payments of save or pay just to be able to compare? Okay, so there is a great resource. So if you go to, just going to make sure I have this web address correct. Okay, so if you go to student loan planner.com, and I'm answering this in the Q&A. So if you want to see this web address, you can go to the answered questions. But it's studentloanplanner.com. And there is a link at the top of the, there's a number of tabs, and one of them is calculators. So Travis Hornsby, he's the lead person there at Student Loan Planner, and he's worked really hard to create some excellent calculators. So I highly recommend checking that out. All right, let's see. How do you know if the attending that is giving you advice is giving you good financial advice? What person actually know their money stuff? Oh, you got that, Steiny. Okay, thanks. Let's see. All right. All right, so I think I answered all these questions. Now, yeah, so this is pretty much it. Does anyone have any questions that they want to ask. If you want to, you could raise your hand and I can unmute you, and we can talk for another 7 minutes or so. Here's a question. Is a financial planner absolutely needed, especially in first years of residency? No. No, definitely not. There's I mean there's a case for it. I guess what I would say is that hiring a financial planner uh in the early years of residency, it can be helpful, like to have someone, but that document that I just shared with you, that is largely the extent to which decisions need to be made. Now, if you decide that they are beyond you and that you are, there's some unique challenges to your circumstances, especially like if there's if your spouse earns a high income, or sometimes people, their spouse works in they work for a company that has like restricted stock units, and um they get like company stock for compensation, and there's some complex things to figure out as far as like taxes and everything. Then yeah, I mean, it might be worth it, but just within the framework of like the decisions that a resident needs to make, that list is what you need to do. Now, if you decide that you want to, like, that you would like the support of a financial planner early on, you can, you could do so. It's kind of like it would be like a luxury, I think, from that standpoint. Some have told me that they like to do it early on because they want to establish trust with someone before they make a ton of money. Because like once you are out of training, it's like, well, like you're gonna get a lot more inquiries, you'll get a lot more emails. Um, so some find it difficult where they think like, well, how do I know if they're really looking at me as a person or our family and our values, and they're not just looking at my income? And that's a reasonable concern. So it's kind of like they cared about you when you had 500,000 in debt, and so they'll continue to care about you when you've got 500,000 in net worth. So that's a rationale. But anyway, that's a great question. Um, when should MS4s apply for SAVE? Oh, so you would do that over the course of your consolidation application that you'll do after you graduate med school. So that's included in that application process. It's a good question. All right, physician mortgage. Thank you for asking that again. I think you asked this like yes, or someone asked this yesterday or the day before. So a physician mortgage is such that you put 0% down, typically as long as you're borrowing less than $750,000, which I hope you are, because that's a lot of money unto itself. Nevertheless, yeah, you don't have to put any money down. The benefit too is that because you're putting less than 20% down under a physician's mortgage arrangement, you don't have to pay what's called private mortgage insurance, or PMI. That typically adds on about 0.4% interest to your loan balance. So it ends up, it could cost anywhere from like 35 to 60 bucks a month more to have PMI. But if you're on a physician's mortgage, they don't charge you the PMI. So that's a benefit too. However, sometimes the overall interest rate on a physician's mortgage is higher than on a conventional mortgage where you'd have to put down 5%. So you really need to do a comparison to see if it's actually saving you money. Because if like a physician's mortgage saves you from 0.4% in interest, but it's actually like 1% higher than a conventional mortgage, you're losing. So it's not always the right thing for everyone. But the major benefit, of course, is that you don't have to put any money down. And like if you don't have a lot, a lot in savings, then that can be helpful. However, it's important that you know that you still have closing costs, which range between 2 and 3% of your purchase price, leaning toward 3 probably. So if your home was like $300,000, you still have to have $9,000 in cash to pay attorney fees, recording fees, prepaid taxes, getting an appraisal done, paying for an inspection. There's all sorts of things that have to be paid for. And then when you move in, you got to wait for the first thing to break because it will. And then where is that money? So you can't like walk into a physician's mortgage with no savings at all because you have closing costs and maintenance costs are going to come right away. So you just have to be mindful of that. As far as like more information about physician mortgages and analyzing buying versus renting, off the top of my head, I gotta think about it. That white paper by Zillow was interesting. If you look at Dr. Jimmy Turner's feed on Twitter, he posted this a few days ago. There's a report about renting versus buying. Actually, I think I could find it. I'll look for it shortly. But let's see. Okay. And then in a complex tax situation, would it be useful to seek out lawyers who have their CFP or stay within the realm of CFPs who work with physicians? Ah, okay. So what you want to do is when you interview financial planners, you want to see if they have any experience working with clients who have like income going through multiple countries. So, there was a time when our family, we lived in Sweden and we were having to deal with that with like Swedish tax law versus US and everything. And so it is complex. So it's good that but to answer your question, I don't think lawyers, a tax lawyer could be helpful. I guess it depends on your questions and what you're trying to figure out. Because lawyers, they're not going to they'll give you good legal advice with regard to the tax laws between countries. But if they have what's called reciprocity, in all likelihood, your husband working in Germany, I'm quite certain that they have reciprocity. He's not going to get double taxed, but you do have to be able to fill out the right forms to do that. So I would tend to say that a financial planner that has experience working with those situations would be worthwhile, at least hiring for like, a project or something like that to get some decisions figured out. Because once you do, like this one couple that came from Slovenia, that I know, they had that situation, and we just had to figure out, okay, how do we report properly between these two countries? And then once it's done, it's done. So it's not like it's different from like having someone manage your investments forever. It's like, okay, we have this situation. How do we figure it out? And if you look for planners that offer that sort of they have that sort of experience, then that would probably be beneficial. Sorry, that was really long-winded, but a great question. Okay, and okay. I'm gonna answer these two questions about disability insurance. And Michael, are you still here?
I am.
Can you answer this question back to the disability insurance? What health conditions are considered enough to be denied?
Oof.
Or is it
There are a lot.
or is that too broad of a question?
So I mean, diabetes is pretty much automatic. Major cardiac stuff. Insurance companies are pretty cautious when it comes to cardiovascular stuff. I think that's probably one of the areas that would be most controversial. A physician who has The experience and knowledge would say, hey, that's no big deal. The insurance company says, yeah, we see it as a pretty big deal. We're going to decline and we're going to rate heavily. Weight management, obesity can definitely be an issue. Uncontrolled hypertension, hyperlipidemia, anything that's out of control is certainly not going to be great. Significant mental health concerns, MDD, and particularly involving any attempts or SIs. There's a lot of things that can cause decline. I guess the safe answer to that would be, in order to buy disability insurance, you have to buy it from an agent. The agent, you're not paying anything extra for the agent that you work with versus John Doe down the street. So whoever you are working with, ask the questions, right? Tell them about your health history, disclose it and say, would this be material? And if you're not super confident that they're knowledgeable enough to give you an accurate answer, ask somebody else. Medical history is definitely a part of the initial conversation that should be happening before an application is ever submitted.
Okay.
Hey, Michael, there's also a question about, is mental health like anxiety, depression, ADHD a consideration for disability?
Absolutely. So if there's anything existing, I'm gonna answer this question, take into consideration that I'm answering it broadly. Every circumstance is going to be different. I'm throwing out all the disclaimers out there, right? So don't hold me to this for your particular situation. If you are currently on medication, there's a very high probability that the condition is going to be excluded by any medically underwritten policy or application. If you took medication and it was fairly recent, 2-3 years ago, chances are it's still going to be excluded. If you took it 10 years ago and you haven't taken it, and you only took it for 6 months, and you haven't had any symptoms or conditions since then, you're probably in the clear. But a lot of it depends on the severity of the condition. Was there any hospitalization? Like I said, was there any suicidal ideation, suicidal attempts? What else was going on? Was there also substance abuse issues, other addictions? The severity means a lot. If you have generalized anxiety and you took an anxiety medication and it's a low dose and you're currently on it, yes, they're going to exclude the condition. It should definitely not lead to a decline or even a rating or anything more than just an exclusion. But mental health is definitely a serious consideration and for any medically underwritten policy, which may sound terrible because, there's a lot of awareness about this stuff at this point. But, just speaking from experience, it has significantly improved 15-20 years ago. If there was any talk of an anti-anxiety, antidepressant, anything like that, that type of history, it might have been declined. The benefit period probably would have been reduced to 5 years. There definitely would have been an exclusion. There would have been all sorts of things. The insurance companies have come a long way on that. But 100%, it is definitely a consideration. Don't ignore it. Don't hide it. Let the agent know that you're working with. If not for anything else, assuming that they're pretty knowledgeable, they're going to set appropriate expectations. A very big part of your experience is going to be, were the expectations set? Did you already know that this was going to happen before it happened? And that's an easy one. If you tell the agent about that type of history, they should be able to tell you what's going to happen.
There were 2 more questions. One says, if I get denied during medically underwritten disability insurance, can I still get a GSI policy? Answer is no, correct, Michael?
Answer is no. So with the caveat, I won't mention exact companies, just because I don't want to go out on a limb there. But let's just say that there is a company out there where, as long as you apply through them, if you are declined, they will accept their own declines and they will offer you the GSI plan. It is one carrier specifically, and you got to go to them first. If you're, if you know that the GSI is there and you apply to a different company, you get denied, that's it. They're not going to give you the backup. But there is one company that will allow you to fall back on their GSI if you're declined or offered coverage with exclusions. The perspective is, if you wanted to do business with them, they're okay with it and they'll take you, because they would have taken you anyway had you just gone with the GSI. But if you went someplace else and you didn't really want to do business with them, right? You wanted to do business with this other company because it was cheaper or whatever. They don't want, you know, the uninsurables or the people with all sorts of excessive risk to come back and go, well, wait a second, now I'm interested. You know, this other company told me I can't even buy it. So that's the concept. That's the logic there.
And then just clarification, when you say exclusion, what you're talking about is the condition will not be covered by the disability in policy, correct?
Correct. Yep. So that
like
condition.
Oh, sorry, go ahead.
No, it's okay. Go ahead.
So if you have, let's say that you have prior issue with your back, you're in a motor vehicle accident, fractured your back. They said, well, we will exclude any kind of back issues that you have on a disability claim. And so they may write that in. And, you know, you say, well, should I get the policy? It's like, there are a lot of other things that happen to you besides back issues. So if that's the best policy you can get, perhaps that's the best policy for you to get, because what, 3/4 of people are under disability claims due to illness, not injury. Is that correct, Mike? Cool.
Yeah, I think it's you know, I can't quote the source, but the last time that I checked, it was like 85 to 90% of claims are illness related, not accident related. So yeah, that is true. Yeah.
So
Yeah,
I
and
haven't been lying
you,
to residents all those years, huh?
thank goodness. Your thought process on the exclusions is entirely right, by the way. I mean, great, you know, the low back is excluded. That's not great. We all want a policy that's not going to include an exclusion on the low back. But at least the thoracic spine is covered, the C-spine is covered, cancer is covered, cardiovascular risk is covered. If you just don't buy the policy because you're that upset over the low back, well, now nothing is covered, right? Because you don't have any coverage at all. So I think expectations is really important there, right? If you are about to apply for a policy and you talk with somebody and you explain that you have that history, it's not going to feel great, but they're going to let you know up front, look, you should go into this expecting this. And if you're not okay with that, then don't even bother, because this is what's going to happen, right? And I think that it doesn't make it any better. It just makes it more palatable when it actually happens.
Yeah, and then the other question we had was, can you purchase a GSI in residency and upgrade to an underwritten policy as an attending when you can afford it? What are your thoughts?
So I tried to explain this in the breakout room to some individuals had these questions too. So GSI, don't think of it as a different product. Think of it as the process in securing an individual disability insurance policy, right? So GSI just means guaranteed standard issue. It essentially means that you can buy that insurance policy without having to answer the normal health-related questions that you would have to if you went through a medically underwritten application. But you're not buying something that's super separate or different. If you apply for a GSI policy with standard, you're getting their normal policy. It might be designed in a particular way. Some companies do have a one-size-fits-all, meaning you can't decide exactly what benefit period you want. You can't decide if you want COLA or don't want COLA. You know, some things are just automatically going to be included on there, but you're not being charged a surcharge. You're not being penalized. You're buying the exact same policy that somebody would buy under a medically underwritten application. So to say, well, you buy a GSI and then you upgrade to like a big boy policy as an attending, not in the general sense that question kind of sounds like it's coming from. The only way that I can say, sure, you can upgrade is GSI plans are capped at 15,000 currently. So if you buy a policy, you buy it as a resident, it's going to include enough future increase option or benefit increase option. You know, there's a ton of different names for that, but it's going to include that feature. And the most that you can ever get to is 15,000. Well, if you're a plastic surgeon, or, you know, I won't go over the specialties, but a higher paying specialty, and you expect that your income is going to be over 350,000 a year, and you might be in a private practice or a group practice setting where you don't have a large group disability policy, that's going to be it. That's going to be your 15,000, right? At 350,000 of income, if you don't have group disability insurance, you can buy $15,000 of monthly benefit. Well, if you expect your income to be 700 or 800, the 15,000 is inadequate. So the upgrade wouldn't be, hey, I'm going to get rid of this, measly GSI plan that I bought as a poor resident, and I'm going to buy this super duper policy. That's not it. It's buying a secondary policy to get more coverage. That would be the only real upgrade I can say, yeah, sure, that makes total sense.
Yeah, and some of the GSI policies you can convert to your own individual policy when you graduate from residency. So that's the other piece to kind of keep in mind. Like Michael was saying, you get the GSI, you can max it out, add another policy on top of it to get the coverage that you need.
Yeah, the secondary policy would be medically underwritten. I mean, in all circumstances, the GSI is at the maximum right now. They're 15,000, and you're not converting it. The GSI is an individual policy, right? It is exactly that. You're just exercising the right to increase the benefit. That's essentially what you're doing. And then once you max that out, once you get to 15,000, if you need more or you want more and you can qualify for it, you would have to buy a secondary policy.
So if I were neurosurgeon resident, it might make sense for me to get an individual policy so that I don't, over my 6 to 10 years of training, don't end up with something that's excluded from a policy later in life, right? And if
Absolutely.
I get the individual with future increase option, then I know I'm going to be able to get enough coverage.
That's correct. Yeah,
Believe me, the disability insurance is painfully expensive. Not nearly as painfully expensive as long-term care insurance, but it's something to get in place, and it's something you want to get in place before something happens. People always ask me, when is the best time to do it? It's before something happens, and we don't know when that's going to happen.
Of course.
Is GSI exclusively employer-based, or can we get it as an individual or personal basis? Group issued